Good evening, everyone. Thank you very much for joining us this evening. We'll be talking about taxes for the next hour or thereabouts. Welcome to this evening's conversation on Mango Capital. It's the first week of the month of July, first month of the fiscal year, and we're essentially just a couple of weeks out from the 2026 Finance Bill having now become law, the 2026 Finance Act. So to recap some of the headline numbers around this, total expenditure for this current fiscal year that we're in now, fiscal 26-27, 4.79 trillion Kenyan shillings in total. 73% of that is just recurrent expenditure. The fiscal deficit forecast at an eye-watering number, 1.11 trillion Kenyan shillings. That's about $8.5 billion US. And that, according to Parliament's Debt and Privatization Committee, is the highest fiscal deficit forecast at the start of any financial year. So the tax policy changes that are now being made by the 2026 Finance Act, these are key, absolutely key to funding this massive spending plan. But the question, of course, you're all interested in is this: will this make it easier or harder for you to run a business or invest here in Kenya and, of course, in the East African Community Trade Bloc as well? We'll explore some ideas around this with our panelists tonight. I'm Magondo, Senior Tax Manager at Deloitte, of course, a recurring speaker in these sessions. Joyce Oriadi, Senior Manager, Indirect Tax at PricewaterhouseCoopers, and Akinyi Gikonyo, the Tax Consultant at the Kenyan Association of Manufacturers. All of them, of course, will be speaking to you over the course of the hour. I want to set the stage here by going to each of our speakers in turn, very briefly, in 30 seconds or less, if you can. Does this 2026 Finance Act leave households and businesses better off or worse off? And you can kick it off.
Thank you so much, Rama, and to everyone. In my view, I would say it did not cure any problems for the taxpayers. If you recall the clamor for especially the change in the paybacks, if that had been effected, you would have said that then households were thought of. But as we speak, I would say no, not really. Actually, if you look at proposals around the indirect tax changes, where we revised tax rates for some goods, for instance, fruit juices, if that may again require the taxpayer to dig deeper into their pocket. So these changes through the Finance Act in 26 really did not leave the household better than they were.
Indeed. Joyce, over to you.
Thank you, Roma. So just to pick up from what Anna's mentioned, I'd want to say from where we sit, it's basically a balance of both benefits and, of course, requiring taxpayers to dig deeper into their pockets. Some of them may not be direct benefits, but they may be able to feel it through the extension of relief for certain businesses. A good example from an excess duty perspective will be the removal of bottled water from the excess duty ambit. We do expect that this benefit is going to pass on to consumers, and we expect a reduction of not just the cost of bottled water, but also the compliance bit that comes with just selling bottled water. Just to pick on another one, again, is from a financial perspective, with the introduction of VAT exemption on realization of security, we expect this to really benefit the individual mwananchi by basically saving the capital part that will have gone into the VAT to be recovered by the banks, and ensuring that basically when there's a sale or a disposal of a repossessed property, then to the highest limit possible, the bank is able to recover, and any balance is then given to the defaulting person. Maybe from a paying perspective, like Anna's mentioned, we had expected changes with respect to the pay bands and extension of the relief given to taxpayers. This didn't come through, so then we expect to feel the pinch. But over and above that, a number of instances where we've seen increase in taxes, both from a VAT, excess duty, and other areas. But just to mention, the other benefit will be on the tax amnesty. I think this is a welcome move, and we expect to see the benefit in the coming months.
Akinyi, over to you. From KM's perspective, does it leave us better off?
Good evening, Rama and everybody else. Thank you. From the KM perspective, this is the Kenya Association of Manufacturers perspective. It hasn't done very much to lower the cost of living, as in it doesn't make any better for mwananchi, because when you look at the VAT element, a lot of what was being produced under zero rate has now been shifted to exempt. And when it's shifted to exempt, it means that the cost of the input VAT will be added to the cost of production, which makes the products more expensive. Yes, I believe that what they were trying to do was to boost economic growth through reforms. However, when you look at the reforms on one hand and you look at the introduction of new taxes on the other hand, then it beats the purpose. because the reforms will just change how it works and make it faster, more efficient. Probably they should have come up with the benefit to the taxpayer where the tax band for payee goes up, which means that then Mwananchi get to have more disposable income. Then we would be saying some of these reforms are good for us, but none of that came through. So generally, it has been said, the experience of whether it's going to make life better for them or not is going to depend on who or which cadre you're sitting at. Because those who drink bottled water, it'll go down, but how good is that for the household? But others then still have to suffer the new taxes which have been introduced. And the money in the pocket remains the same because the benefit of not taxing up to 30,000 didn't pull through.
And we'll start to get into the details of a lot of those indirect tax changes, changes to value-added tax, to excise duty, and so on and so forth, in quite a bit of detail in the course of the hour. And yes, I do take your point, and we've heard it from all of our speakers, that we had a massive missed opportunity here in leaving personal income tax completely as it were, despite promises that we had. And there was a lot of conversation around this from the government, especially in Q1, parts of Q2, around tinkering around the tax ban, providing a bit of relief, but clearly none of that came through in this particular act. And one of the last things we discussed when we had a session on, as it was back then, the 2026 finance bill, there was this proposal to tax merchant service and interchange fees under an expanded definition of management and professional fees, in effect, in response to that loss in court in a long-running case between Kerry and ABSA. But now that those proposals have become law, how exactly does this work from a tax payments perspective?
So what will not actually, today being 7th, becomes the 5th day from the day the law came into effect. So I would expect that today the affected payers did remit withholding tax on this introduced scope of merchant service fee and interchange fees. When I check around, especially with the people in the financial sector, what I understand is they're still struggling to effect this because, as you may recall in our previous discussion, we think that this issue of card network, it's a partnership of 3 key players. We do have the issuing bank. This is the bank that gives you the card. Then we have the acquiring bank. That is the bank. For instance, say if you have a Coop Bank card and you go withdraw money using the Equity Bank ATM, then Equity becomes the acquiring bank. Then we have now Visa coming in, or MasterCard, providing the channel, the network through which the transaction is completed. So in fact, this way these banks charges each other for that partnership. And in one day, you may find that, for instance, Coop owes Equity more, and then the following day they owe them less. You find that this is a moving kind of point for taxation, and the challenge they're having is now getting to exactly establish the incidence of this taxation. So that they're still struggling with. I'm not sure if KRA has gotten any money by the end of day to day. Then looking at it now from the aspect of merchant service fee, this now affects mainly the merchant, specifically mainly the supermarket. And you could also see the petrol stations where you go and swipe your card. Again, now this merchant is enabled through a specific bank to use their POS to collect money from the buyers. So what these merchants have agreed with the owners of the POS is that we will facilitate you collecting money through the POS and the cash, or hard cash. But for that service, then we'll charge you the MSF or the merchant service fee. So it is upon the merchant, that is the petrol station owner or the market person, now to withhold tax based on the law as it became effect from 1st of July. So this merchant also has a challenge because they have no visibility of how the amount that is deducted from the payment made is distributed among the 3 parties again, because now we have the acquiring bank again, the issuing bank again, and also the network owner, either Visa or MasterCard. So in terms of this getting to be implemented, it is a challenge. So we'd expect that in as much as it's already low, we'd expect that the Commission again engages specific sector players so that they can have an understanding on how this can be operated, because it's just complex for all the parties involved.
Just one quick follow-up for you, Anne. Do you think this sort of tilts the playing field in favor of mobile money, or just going back to use plain old cash? On one hand, yes, there's lack of clarity around how these taxes will be applied, but also two, from the perspective of the consumer, the perspective of the business. Given how tight disposable income is at the moment, businesses and households will probably be like, hey, do I really want to deal with the extra charges that can be passed on to me, even if it is convenient?
What you find might likely happen is that the merchants may be not willing to proceed with the issue of card payments because there are other alternatives. Why they will do this is because of the additional administration cost that comes with withholding tax. You well know that withholding tax becomes a payer's burden. If you do not withhold, then in case of a review by the KRA, then they can penalize you. So also I find an instance where we might have shortages of merchants agreeing to get our cards to make payments. So in a way, then there'll be some unlevel playing ground where you find now people opting for mobile money or hard cash. Yeah, that might affect in a way.
Joyce, do you want to weigh in on this?
Sure. So maybe just to add on to what Anna's mentioned, we do expect a lot of complexities around the practical administration of this particular change. None of the things that we then foresee, like Anna's mentioned, is the question will be, do you really want to go through the compliance requirement that comes with just being able to track some of these multiple transactions? Because you can imagine in any given day, in an hour, how many transactions are done at the supermarket or even at any other supplier who then uses the PDQ for purposes of payment using the card. So we expect a lot of challenges around this area. We expect a lot of pushback perhaps from the industry players that have been applying this over time, and definitely see a lot of probably restrictions around the continued use of this until they find a proper structure that works for them. I think one thing I'd want to point out in this particular change is a departure from an international best practice perspective, because when you're talking about management and professional fee, we expect some human intervention to come in. So this is a departure from what is expected from that angle, and it could be then used to incentivize the use of cash payment and mobile money payments, as you've just mentioned, Raman.
Do you reckon that could extend to maybe a court challenge to that specific clause, given all the issues that you and Anna pointed out in terms of how difficult this is to implement? And I know these are warnings that were issued well in advance. KBA had a whole position paper out of it, and I'm sure Deloitte and PwC also had position papers out to finance committee saying, guys, this is not practical. This is not the way to go. Do you expect a court challenge?
I'd say so, Rama. It depends on the appetite of the industry players, because then it will be from a basis of perhaps public interest and the impact of this definitely in the financial inclusion area. But it's majorly based on the appetite that the different players have, and probably we need to see if then this is going to be queried by the different players.
Indeed, certainly a story to keep a very close eye on there. And I want to move on to something else, because the Finance Act also has gone after what they described as an indirect transfer of Kenyan assets, right? So, for example, Kenyan firm operating in Kenya, you think about how it's been structured, principal shareholders are located maybe in Dubai or in Mauritius, for the sake of argument. And the idea, I think, was to try and capture, quote unquote, some of the value that might come in when a private equity fund or a VC fund buys stakes in Kenyan firms, but that transaction takes place offshore. Does this make Kenya less attractive for foreign investors? And how exactly will this work? Because we've got double taxation agreements in place with some of these places like Mauritius and the UAE.
So, Rama, what you'll note is that the issue of taxation of indirect transfer of shares actually came in through the Finance Act 2023. That is when the amendment was changed within the law to bring this to the ambit of taxation. But then at that point, there was some drafting error in terms of referencing to the specific subparagraphs within the schedule that guides on taxation of gains from indirect transfer of shares. So what has been happening then from 2023 to now is that in terms of implementation and collection of taxes by the KRA, there was a mismatch because now the law was not well coded. So what we've seen Finance Act 2026 do is try to correct that error, but at the same time, it has also washed away, or rather, I would say it has negated what was initially in the law. Why I say this is because when the Finance Act 2023 came into being and brought in this regime of taxing and indirect transfer of shares, there was good reference to best practice, that is international tax best practice. And the law was provided very clearly in terms of thresholds that must be met for a transfer to qualify as an indirect transfer of shares, and therefore subject to capital gain tax. Specifically, you'd only deem a transfer to be taxable if at least 20% of the value of the transfers would have been attributed to the shareholding in Kenya. So with the Finance Act 2026 introducing a new subparagraph below what we have already, those thresholds have become ineffective. They are of no consequence going forward. So this leads to overlaps in the tax law and, of course, creating a lot of uncertainty. And that is why you find now deviations from what you'd call the international best practice. And as you put it rightly, where we have now agreement in terms of double tax agreements, and then the provisions of the double tax agreement will prevail against our domestic law. So what is that for countries where we don't have double tax agreements, then the investors in those countries will not be treated the same way as investors in countries where we have enforced. So what we feel should be done as maybe a matter of urgency is just to make sure that the law is aligned to reduce the confusion that has just been brought by that specific subparagraph that has been introduced through the Finance Act 2026.
Okay, I'm going to come back to you on this on my next question, because we've got a lot of firms, including some of the members of the Association of Manufacturers. They operate right across East Africa. You've got either suppliers or subsidiaries or clients in Uganda, Tanzania, Rwanda, DRC, and so on and so forth. And now that dividends to EAC citizens are no longer enjoying the old withholding tax rate of 5%, can be hit with a 15% rate instead. Isn't that going to make Kenya a less attractive place for EAC money to invest in? And how does this then affect your members at KM? Because we've seen complaints as well from Uganda, where they're saying some of the taxes that are being imposed on the Kenyan side are in violation of the custom union protocols that we signed up to.
Good question. I will respond to the first part of it, which I would confirm that it will make Kenyan firms less attractive to venture capital and private equity by increasing tax risk on cross-border shares. So you will find that the FDIs would prefer to find other destinations where it's easier for them to do business and not lose their finances. On the issue of Kenya imposing taxes on goods coming out of the region, which then would result in what we call discriminatory taxes. Yes, we do have an element of that. And probably I can share that earlier on, before 30th June of this year, East Africa was all behaving in a manner that we can say they were behaving badly, because you find that all of us were charging local domestic taxes. These are taxes which are national related, as in VAT is a domestic tax specific to Kenya. Excise duty is a domestic tax specific to Kenya, while import duty is a tax and the rate is standard across East Africa. And if we read the protocol and the treaty that brought EAC together, they say that none of the partner states will apply a national tax on goods coming from any of the other partner states that is not applied on her own product. So you find that we have excise duty, for example, which is chargeable on imported goods. And when we talk about imported goods, then you find that EAC goods coming in are treated as imported goods. And this is what then they're calling discriminatory taxes. And the minute that Kenya does this, then we have East Africa retaliating. And when you look at the trade balance, there's quite a bit that we as Kenya really want to be careful about, because we have quite a huge chunk of the EAC market. And if we are not then able to access that market, what it means is that somebody else will find that space. And it doesn't necessarily have to be an East African partner. It could actually be from beyond East Africa. So which means we actually lose our market share. And when we lose our market share, it means we are transferring jobs from outside of Kenya to wherever the supply that is coming to eat into our market space. It's important that we get that corrected. And East Africa did agree that by 30th June, all partner states will have their laws amended, because that's the time we all amend our tax laws during the budget period. And if you look at Kenya's position, this is something that didn't quite come out for us. And that's why we are getting a bashing coming out of the region.
What should we expect to happen next? Because, and I'm going to go back to the court option in the same way that I asked Joyce earlier, right? Because on one hand, if we sign up to these protocols and we say we want to make it easier for companies within the trade bloc to trade with each other, to invest in each other, and yet here we are putting up all these roadblocks. Do you expect a legal challenge either here or the East African Court of Justice?
In the past, what has happened is we have had court processes, and we actually have court rulings from the EAC Court of Justice, where the ruling is that we must remove the excise duty. And you will find that Kenya has had to remove. I think Uganda has also had to remove. And there's legislation that shows that we actually had to step back on what we had earlier imposed on these goods. My only concern is that we seem not to pick up the lessons, because we go through it and forget about it tomorrow and reintroduce excise duty on these products. I don't know, but we are hoping that this will be changed. If it's not changed, watch this space. The region is going to impose those taxes specific to Kenyan goods. Tanzania did this. The period about September, October of last year, they introduced a new law. And if you looked at that new law, if you looked at the products listed to attract that new tax that was introduced, were the products that Kenya transferred to Tanzania. And really what they were doing was they were retaliating to the position that Kenya had taken.
So it's going to be really interesting to just keep tabs on how this 2026 Finance Act essentially plays out, not just within the country, but of course within the East African community as well. Joyce, I want to come to you because indirect taxes are your area of specialty, and there were multiple changes to the Value-Added Tax Act that was done through the 2026 finance bill. That includes things like changing the period in which you can apply for VAT refund from 2 years to 3 years. But walk us through the changes to the VAT Act that stand out for you and the impact that's likely to have on households and businesses.
So like you rightly put it, one of the changes that came through the Finance Act is basically an increase in the minimum qualifying period for VAT refunds on bad debts. You will recall that before the Finance Act in 2025, we had that particular limiting period of 3 years. And then the Finance Act in 2025 did introduce a new period of time, which was 2 years. And now we've seen another reversal back to the 3 years. We expect that this basically was a reaction to the Revenue Authority feeling a lot of pressure with the increased number of refund applications, and also just trying to seek to ensure that ideally the recovery options are exhausted fully. But what we expect from these particular changes, then we expect to see a lot of delays around VAT recovery, which will in turn then impact the cash flow impact of businesses. So this calls on businesses to just reassess their cash flow positions and ensure that their credit terms then are favorable and take into account any delays in getting such refunds. Just to mention a number of other changes that impact on compliance, and this is going to impact all businesses that are registered from a VAT perspective. For any items that have since been reclassified from exempt to taxable, that will be either taxable at 16% or taxable at 0%. Then there's an introduction to then claw back the input VAT that had been claimed. So in this particular case, input VAT is basically the VAT that you pay on the expenses that you incur for purposes of making supplies. And what the Act has introduced is, in instances where the supplies you're making have changed from being taxable to exempt, you're then required to reassess or to account for the input VAT that you had claimed earlier on. Using the same formula that you had used to claim that input VAT, you're supposed to do the same on any goods that remain unsold. And this then means that there'll be a cash flow impact for any business that results into perhaps excess input VAT having been claimed in relation to that. The second thing that I'd want to highlight, and this is a welcome move, is that for any businesses that are making supplies to our defense forces, this will be the Kenya Defense Force, the Defense Forces Welfare Services, the National Intelligence Services, and the National Police Services, which are ideally exempt. The law has then been amended to allow for input VAT deduction and application of refunds relating to any excess input VAT. So ideally, the general rule is if you're making supplies, exempt supplies, you're not allowed to claim back input VAT. But this then is an exception to that general rule, and it's a welcome move for businesses making supplies to these particular agencies. Maybe just to highlight another major change from a VAT perspective, from a labor outsourcing perspective, we see a big VAT relief for businesses involved in labor outsourcing, where employee-related costs are then excluded from the taxable amount. So this is a response to a number of High Court decisions that we've seen in the recent past, where the High Court then decided that where a supplier is supplying staff or placing their own staff to other entities to support with their operations, then in terms of just invoicing for their costs or the cost they incur to make that particular supply, you'll ordinarily normally see that they charge a service fee for that particular labor outsourcing supply. And over and above that, they will recover the salary components. So this will be salaries, wages, or any other statutory deduction, and then account for the same to KRA. And for the longest time, they only charge VAT on the service fee component or administration fee that they're using to manage the HR services that they're offering to this particular staff. So this change really is a relief and brings certainty. It removes the need for such suppliers to prove the principal-agent relationship. So this is really a big win for outsourcing and shared services model. Just to highlight some of the biggest wins we've also seen from an investment perspective, we've seen an introduction of exemption to both services and goods that are incurred or rather purchased or imported for purposes of use in public-private partnership infrastructure investments. So any such goods or services will be exempt from VAT. And over and above that, there's equally an introduction of an exemption that is going to benefit any projects that are covered from the infrastructure fund that we recently, the government really put a lot of interest around this. So this is indeed a welcome move. We expect to see a lot of investments starting from this, but a key one to note is we don't expect to see a very big benefit in instances where such supplies are then bought locally. And this is because the suppliers of these services or these goods are going to be restricted when it comes to the input VAT that they can claim. And in the past, or from an operational perspective, we've seen such suppliers then embed these costs in their pricing. So you'll not really feel the benefit to a large extent. Maybe just one last one that I can highlight is from a financial services perspective. For the longest time, we've seen all services related to money transfer services exempt from VAT under the first schedule to the VAT Act. However, we had an interesting amendment introduced by the Finance Act 2026, and this was basically to then separate the auxiliary enabling services that facilitate money transfer services. So what that means is any payment processing, settlement, merchant acquiring, or similar services that are offered on a platform or a software by a payment service provider are then going to become taxable at 16%. So this is expected to increase the transaction cost and, of course, a possible adverse impact on digital innovation and inclusion in the sector.
Just to latch onto your last point there, Joy, essentially, I'm using services that are coming from some of these firms. I should expect some pass-through effect, right? Higher costs to be coming through, and I'm using services that have a PSP behind them, like Pesapal, for example. If I'm paying my ISP bill every month and I'm using Pesapal, or rather some of that money has to go through Pesapal to make that payment, those costs will be inevitably passed on either to the consumer or the service provider, right?
Yes, so you're right on that. We do expect an impact and for that to be passed on, especially in instances where perhaps there are no means of recovering the input VAT or the services, then we will expect a higher transaction cost and it will be passed on to the consumers.
The Silicon Savannah, or rather the grass on the proverbial Silicon Savannah, will start to dry out quite quickly at that rate. The Excise Tax Act also got quite a few changes, right? They're applying it to services offered by virtual asset service providers, pretty much along the lines that you mentioned. We're looking at higher tax rates on a whole range of items, denatured alcohol, imported sugar, a whole host of ceramic products. Walk us through the changes that stood out for you there and the impact that's going to have on businesses and households.
So from an excise duty perspective, I can walk us through a number of the major changes that we see or we saw come through the Finance Act 2026. And key among them, like I mentioned when we started off, was the removal of bottled water from the scope of excise duty. Like I mentioned, that is a welcome move. It's been something that the industry has fought for quite some time, and the government has pushed back on this for a very long time. So the benefit or the key relief goes with, of course, the reduction of the excise duty compliance aspect, including the requirements around the excise stamps. And we've seen a notice being issued by the Revenue Authority, just speaking to the fact that they're going to issue guidelines on how to go about the return of the excise stamps that had been purchased by the industry players in this space. Another key change is what Anne highlighted at the start, basically a differentiation of the rates for fruit and vegetable juices. Initially, all fruit and vegetable juices attracted excise duty at about 14 shillings per litre, but now the Act has sought to then differentiate the bit that is sweetened and what is unsweetened, with sweetened juices attracting a higher duty at 20 shillings per litre. And of course, with this, we then expect to see some increased costs for sweetened juice. A key benefit, I think, to the players in the alcoholic industry, the players, both distillers and the compounders, is the change with respect to the reduction of the excise duty payable on ethanol purchases. So this is spirits of undenatured extra neutral spirit with an ABV or alcohol content of above 90%. So there's been a reduction from 500 shillings to 80 shillings, but this is only capped and limited to licensed manufacturer of alcoholic beverages. So we do expect this benefit to then be passed on to consumers with expected reduction in prices, but we leave to see whether this is going to be implemented or not. Of course, now from a tobacco perspective, we've seen an increase in the excise duty chargeable to the categories of tobacco products covered under the Act. Such huge increases, and maybe key one to note is an introduction of a new category. Oral smokeless tobacco products will now attract excise duty at the rate of 2,000 shillings per kilogram. That's a new change over and above the already accessible tobacco products. Maybe just to mention, again, we've seen an increase in the excise duty rate for imported sugar with the exclusion, of course, the pharmaceutical space. And this is basically a move that we've seen the government take in a bid to protect the local industry. There's a lot of investment or policy changes we've seen geared towards just promoting the local industry ability to then manufacture or process raw sugar. And probably this is what then led to this particular increase from 7.5 shillings per kilogram to about 40 shillings per kilogram. So this is indeed a huge increase, considering that currently the local industry has no capacity to meet the demand for white industrial sugar. Maybe just to mention one last change is for the expansion of exemptions to goods supplied for official use by the National Intelligence Services. So similarly, we've seen this introduced from a VAT perspective, and we're seeing a similar introduction, extension or expansion from an excise duty perspective. So basically just to ensure that there's an alignment in the treatment of supplies made to these security agencies.
Akini, I want to come to you from KM's perspective, just to pick up on what Joyce was talking about there. Do manufacturers really need that import shield that some of these higher taxes would provide? Because looking at the sort of documentation that we have, looking at higher taxes on imported medium density fiberboard, particle board, blockboard, plywood, timber, sugar, of course, which you spoke about a little earlier. What's the utility? What's the value for Kenyan manufacturing?
Thank you. And thanks, Joyce, because you've listed practically everything that had excise being impacted by excise. First of all, let's just understand what is excise duty. Historically, excise duty was charged on luxury goods. It was actually called a sin tax. It was charged in gambling. It was charged on alcohol. It was charged in jewelry, stuff for the high end. Now, excise duty is a consumption tax. From a manufacturing perspective, you've just mentioned the particle boards, the sugar. These are input to manufacture the next product. This is like the seed. When we talk about industrial sugar, Joyce just confirmed that we don't have the capacity to produce industrial sugar. We have one company that is in the process of producing industrial sugar now, and it is important that we allow them or we support them to produce the industrial sugar. But we should have a transition where as they are growing, then we are stopping or reducing imports of industrial sugar, but we don't. What we've done is by this increase of 40 shillings per kilo is we are frustrating our confectionery sector. And the 40 shillings that is going into each kg of sugar is actually translating into an increased cost of all our confectionery. So for the manufacturers, this is not working very well. And probably if it's about raw sugar, which we are producing, if it was restricted to raw sugar, then it could make some sense because we do have industry that is producing the raw sugar. Do we have adequate for Kenya's consumption? Probably, again, think about an exemption for the deficit that we may have. But if we have adequate, and if this move was informed by data, then we would be saying we've got enough brown sugar, we don't need to import, so impose that if necessary. But as the way it has been done, for sure it's going to impact our local product. And again, it opens up room for, because where there's a vacuum, somebody will fill it. I think this is something that should be discussed and impacts assessed, and we see what to do. But the Kenyan industry would just be asking for a level playing field. Because again, remember, we are not the only producers of confectionery. East Africa is producing confectionery. So if we look at confectionery coming out of Kenya, we are already sitting at 40 shillings per kilo on our raw material. We also have sugar levy that is sitting on the same sugar. And we have all the other taxes, railway development. And there's so much that is happening that is not being evaluated as we are putting. But I appreciate the fact that we would be wanting to protect the farmer. We would be wanting to protect the industry that is producing, but we must be careful not to kill any of the other industries. So from a manufacturer's perspective, we are happy. If government feels there's need for protection, why not? When you talk about the furniture sector, it is true again, we have industry that produces the particle boards we are talking about. And yes, we should actually encourage use of our local particle board. But it is true also that we may not have all the different classes of particle board for what we are manufacturing in Kenya. So the question is, can we have that conversation and agree that this is being producible in Kenya, and industry making it? How much time would you need to be able to put the next item, rather than just come up with a slab, which may then affect a certain quality of product from being produced in Kenya? And finally, again, when we look at excise duty, you find that the goods which we export out of Kenya will carry with them the cost of the excise duty that was charged on the input. For example, all our confectionery goes out plus that excise. When you look at our containers, our packaging containers, they have excise duty on them. And if we are exporting, that excise element is exported with that. Our packaging containers for products made in Kenya attract excise duty. The products being imported into Kenya in the same container, right? Similar goods coming into Kenya in similar or identical containers do not have that excise element. So again, even on our local shelves, you find that our product is more expensive than the one that is coming from outside. I think what is lacking is a conversation, a national conversation, where we understand or we evaluate the impact of the tax measures that we are putting in place and appreciate exactly what it is doing to the bigger economy, rather than look at it from a manufacturing sector perspective. And that's why I say I appreciate the fact that we are looking at protection, but I also appreciate that as we are protecting, we are not killing the next sector. And this is something that done by sitting at a table and just understanding the impact that it has on the wider industry.
You've given me the perfect setup for my next question, because I want to bring back Anne into the conversation. I'm sure a lot of these issues that McKinney's flag, these came out in submissions that were made by industry, right? By KM, by specific manufacturing companies. If we read through the report from the Finance Bill, a lot of these concerns, I believe, were raised at that specific point. So from your perspective, Anne, to what extent do you think this public participation process is actually having an impact on the law that we eventually do see? Are you seeing any evidence here that, you know what, for the most part, when we as industry say XYZ is bad, or it would be inimical to us because of this, that, and the other, are you actually being listened to by MPs? Or are they just saying, you know what, we need money, we've got to fund this massive spending plan of 4.79 trillion shillings, therefore revenue at all costs, that's our priority?
That's a good one, Rama. And from the parliamentarian perspective, it's always not an easy balancing act. But where credit it's good to give them, what I note is that there were few proposals in the bill that were very adverse And we could see that after the participation that dropped off. You may recall there was the issue of issuance of agency notices while the matter was still being argued either before the tax appeals tribunal or high courts. So that proposal came through the finance bill that then carry being empowered to raise agency notices as much as the case is ongoing. So for that, I see that was dropped by the committee, which was a comfort that at least though some listening to that. We also had a proposal in the bill in regard to introduction of minimum deemed dividend that should be distributed. The bill was proposing that there's a ceiling for carry where they could deem at least 60% of retained earnings not distributed as distributable if they see that the taxpayer does not have grounds as to why they have not been distributing dividends. To that extent, you'd say that those I'm hearing. I will also note that there are a bit of variations again within the proposals. They were in the bill and finally what we get in the Finance Act, specifically note at the issue of where KRA are given the powers to rate assessment based on the information that is in their custody. In the bill, there was no room for the taxpayer to argue their matter. But when you check through the Finance Act, you'll find that the taxpayer is now given some room just to counter the assessment, the findings of the carry before this issue is escalated. So to say that is something different I've seen with the current committee that was sitting, some listening. But of course, we do know the problem that we have as a nation is revenue drive. So in as much as we say we are being heard, of course, they had to have their cards again well aligned to ensure that there is again a plowing back of some revenue to meet, of course, our ever growing expenditure that we budget even before we know where the money comes in. So in a nutshell, that is what I would say. There was some deliberate effort by the committee to listen to the issues raised by the participants during the session, public participation.
Isn't it a concern for you, Anne, that some of these ideas that we see in various finance bills, there's some ideas that just keep coming back in slightly different, slightly altered forms, but they just keep coming back. Like this idea that if you're going to challenge something at the tax appeals tribunal, you had to deposit X amount of, I think it was like 50 or 100%, depending on the year you're looking at, of the amount in dispute, right? And that came back in the 2026 finance bill, and it wasn't the first time that we'd seen that before in another finance bill as well. Doesn't that raise concerns about whether or not this public participation process is actually working as it should? Because if you look at an idea in the past and you've rejected it, and then it keeps coming back, at face value, that's just our legislators telling us, by the way, we're not listening to you guys.
I think it's a different, I would say, houses within the government arms, because we have the Treasury here drafting the bill and then being presented before the Parliament. So yeah, it leaves a lot to be desired as into why an issue that was proposed, and there's this well documentation as to why it was dropped by the Parliament, keeps coming back. But in my view, I would say it is more about the revenue pressure. And I think then that calls for bigger discussion or more conversation around our revenue raising measures and also how we spend this money, because trying to sneak in something, 1 dream, 2 more attempt just to collect revenue without really addressing the root cause of revenue charges, I think it's not in the best interest of our country and also for investors and taxpayers. I think going forward, then this calls for the drafters of the bill, especially the Treasury, to do more in terms of finding ways in which they may mobilize more revenue. We have to at least appreciate the current times, in terms of digitalization. We can leverage the data that is there to improve on the compliance levels in terms of ensuring taxpayers each pays their fair share of taxes. I think that would be a better way to look at it than trying to keep rotating around the same issue, not giving very good grounds as to why this has to come back. It's not really even the best way to manage time for the various stakeholders. They need to engage more with the business people, with the other arms of the government to ensure that by the time the bill is released, it is something that is worth considering and that there are no repetition of what had been brought and maybe did not see the light of day.
Just one quick question for you, Dan, before I let you go. There was a proposal, of course, here to tax offshore landlords as well, which I believe essentially passed into the Act. So there's a specific tax regime here for non-resident landlords who earn a rental income from property in Kenya, 30% on rent, premium or similar payments for immovable property, 15% for where the rent is coming in from property other than immovable property. Eric here wants a deep understanding of exactly how this works, because I know there are Kenyans in the diaspora who may own homes or may own commercial property here in the country, but they're not quote unquote tax resident as such here at the moment. How do you see this working out?
I think, in my view, it's just, again, trying to ensure taxes are paid. Because what we had before the Finance Act 2026, the regime was more of a withholding tax for non-resident who have property in Kenya. Then you find these properties could be there occupied by, say, individual person. It would be so hard for an individual, myself and yourself, withholding tax for a landlord who is not within the country. Where they involve corporate, it would be easier in terms of compliance level and also in terms of carry trying to follow up to see if the corporate are complying with the law. But where individuals come into play as tenants, then there's a likelihood of non-compliance. So I think it's just a smart way to ensure we lock in the revenue, where now we call upon the non-resident to register and pay their due taxes. In Kenya, it's a more of a simplified framework for them. The rate is the same with what will be withheld by a corporate. So there are exemptions to it. So if you're a non-resident, your tenant who is in Kenya withhold tax, then the non-resident will not be required now to comply with the new regulations. Also, if you're a non-resident and you have also appointed a local tax collecting agent, so that is also easier in terms of reach by the Revenue Authority in terms of checking on the compliance levels. So they're looking at those property owners who are non-resident and who could be hard to reach, especially if they have individuals as tenants.
Kenya, I'm going to come to you for my last question, really, for this entire session, because we're coming up pretty close to 9 p.m. There were multiple proposals in the bill that did not make it into the Act, right? Including the ones that changed the way value-added tax would apply to electric bicycles, batteries used in solar power systems. Assuming these proposals had become law, how would it affect the business of assembling electric motorcycles or the uptake of solar PV systems? Because I know some of the members of KM have been on this really serious investment drive over the last couple of years to add a lot more solar PV panels, solar batteries, or other battery storage systems as well, to wean themselves off slowly off electricity from the grid. So if these proposals have become law, how would that have affected KM?
The proposal was that we zero rate the e-motorcycles so that assembling them is cheaper than it is right now, and so that they are more affordable to mwananchi. If this had come through, it would mean that we are selling more bikes. It would mean that our investment is bigger than it is now. And it would also mean that when we are talking about the green environment, Kenya would be complying more towards the position where we're supposed to be. But again, you find that what we did was we brought it to an exempt position. With exempt, what this means is that it'll be more expensive because the input VAT will be absorbed into the cost. When we talk about solar, it's the same story. It's to try and make the solar products cheaper than they are today. When you look at the cost of electricity, it's very high, whether we are talking about it at house level or whether we are speaking about it at industry level. Today, you find that quite a number of industries have actually installed solar power to support the business activity. And this is just industry trying to make things work out cheaper so that what we are rolling out is cheaper. So when we introduce this, then a policy decision comes to increase the cost of the item, then it negatively impacts the objective that we were trying to achieve. So in principle, all we're saying is, if I'm to restrict myself to the bikes and solar, it's just about reducing the cost of doing business. But in principle, what industry is saying is, let us try and avoid taxation on input. Let us collect the taxes on the finished product. Because if we leave it on the finished product, then it means that it will be more affordable to mwananchi. There'll be no element of double taxation at any point. Because when we put it into exempt, the input VAT is charged VAT at the end of the day. And this is what we are then trying to avoid. If it is zero rated, then the input VAT is removed because the manufacturer can claim that back. If it sits at 16%, it means that the manufacturer can offset it. So the worst point that manufacturer would want to be is an exempt position. When the finished product is exempt, then all the input VAT forms part of it. Let me just give you another scenario. We have finished products, imported finished products coming into Kenya, exempt, while the input to manufacture the same product in Kenya are VATable. So what does that mean? If these products are coming from the next country and it is exempt when it lands in Kenya, it could be coming out of a scenario where the input VAT in the country where it's coming from is all knocked off because it's zero rated because that's an export item. While the Kenyan products being manufactured here is loaded with all these taxes. So again, it's just about what do we want to achieve? But we want to acknowledge that we have many players. We have traders, the importers. We have industry A producing the product that industry B need, and they feel that's a finished product and would want it charged. And then we have the industry at the end of the supply chain that is then absorbing it, and it is either exempt or it is taxable. But what are we then saying? And that's why I say that we want to sit down and have this conversation. And remember, all these people are making proposals to Parliament and to Treasury. It's not only KAM that puts in proposals. Parliament has a bird's eye view on all the proposals. Treasury has a bird's eye view on all the proposals. Mine would be, let's just be objective and make a decision that supports Kenya's industry. Let's see how we balance it out. It has to be balanced out if we are to continue growing our industries and maintaining the jobs. Thank you.
Indeed, I don't think I can find a better note in which to actually wrap up this conversation that we've had on the spaces for the last hour and a bit. Anne Magondo, Senior Tax Manager at Deloitte, Joyce Riadise, Manager of Tax and Indirect Services at PricewaterhouseCoopers in Kenya, and Akin Gikonyo, Tax Consultant at the Kenyan Association of Manufacturers. Thank you very much for your time and your thoughts and your ideas. And of course, we'll have more conversations on these issues as the weeks do go on by. Thank you very much. Thanks, everyone.